Welcome to Paging Financial Freedom, a podcast about doctors and spouses and the journey to financial freedom through real estate and tax savings. I'm Dr. Daniel Shin, a surgeon and real estate investor. You might know me on social media as the Darwinian Doctor or the founder of Serious Real Estate.
And I'm Lila Kaplan, former Wall Street professional, certified financial planner, and the person on a mission to retire my orthopedic surgeon husband in the next 5 years. I specialize in apartment investing, helping doctors and their families build true financial freedom beyond their W-2 incomes.
If you're interested in achieving tax-efficient financial freedom through real estate, you're in the right place.
Let's get started.
Welcome, everyone, to the Paging Financial Freedom podcast. As always, I'm Daniel Shin, the Darwinian Doctor, and here with my co-host, as always, Lila Kaplan. Lila, how's it going?
Hi, Daniel. Great to see you again. I'm doing great. I'm especially excited about today's guest because his story has some real parallels to the conversation that we've been having on this show. The tension between security of a steady paycheck and also the pull towards something even bigger.
Absolutely, because today we've got Teddy Mohlman. He's the founder and CEO of Higher Ground Investment Group, a Denver-based multifamily real estate firm. And, today we're going to really get into the story here because, it's a really compelling story. He didn't start in real estate. Teddy went to culinary school, worked as a private chef in Miami, pivoted into corporate sales as an account exec at a food distribution company, and then walked away from it all. Now he built a real estate portfolio that spans hundreds of units across multiple markets. He's a pilot, as we know. Teddy, welcome to the show.
Awesome. I appreciate it, Daniel. Lila, thanks for having me.
Yeah, and I would also say that Teddy has been very instrumental in me getting into the multifamily space. And I would say that he's probably my first mentor in the multifamily space. So,
well, I appreciate that. Yeah, I'm very fortunate to have a lot of people help me to get where I am today, and I'm always happy to repay the favor.
Full disclosure, Lila and I did invest into a deal with Teddy in Des Moines that is currently underway. So, with that backdrop, I'd love to go back to the beginning, Teddy. So, your origin story is, so interesting. Tell us a little bit about, where did Teddy grow up? Where did you get your start? And then where around the country did you get up to?
Yeah, so I've definitely bounced around a lot in my younger days. Born and raised in Miami, Florida. When I was maybe about 16 or so, I shipped off to boarding school just to kind of see what that was all about. Maybe also partially because I was a little bit of a naughty boy when I was growing up. Came back to Miami after that, finished high school there. And then when I was kind of looking for college experiences, I wanted to ship out and do something new. So bounced around from California up and down the coast there for a little bit. Loved the West Coast. Just ultimately was a big surfer and hated the cold water. So had a one-way flight to Hawaii and was supposed to be there for a short bit and stayed for about 4.5 years. So with that Hawaii experience, that's where I kind of jumped into the culinary experience that you had brought up, Daniel, and loved food and beverage, loved always being kind of the life of the party, and thought that I can kind of make that into a career. So with that, I did my culinary background in Hawaii for a couple of years and eventually landed back in Miami as I thought it'd be a good place for me to start a private chef business, which I did there from about 2014 to about 2017.
So what are some of your favorite things to cook?
Being close to the coast at the time, a lot of raw fish was implemented into our menus. I mean, granted, depending on the clientele, we did a lot of high net worth individual. We do a lot of dinners there. So it would be really kind of curated to what their likes and needs were, but a lot of fresh fish for sure.
Nice. I love it. I love seafood.
Yeah, no. So we had a good time and it was fun. I loved it, but we'll probably get to this, sooner or I guess in a bit here in the podcast. But I was just able to really get my eyes on, again, a lot of high net worth individuals. And whenever I was able to connect with them, there was a common trend and they were all relatively connected to real estate. So that's what sparked my next venture.
That's so interesting. So, in Miami, when you were interacting with them, how did you get into those conversations where you were even sort of privy to what they were, how they were making their money?
Yeah. I mean, granted, a lot of the events that I would do would be in their homes, right? So I would come there to prep. Let's say the dinner was at 8. Miami usually eats pretty late, so I'd get there around 3 or 4 and start prepping, and I'd be pretty much in their home. So it was pretty common for me to connect with the clientele, and I mean, some of these houses that we work at, there'd be multi-million-dollar yachts, on their dock on the water, and I'm pretty I'm a people person, so always was able to kind of get some information out of them and always sparked a conversation with them, and they were always super nice, and ultimately was able to kind of get some information and just kind of see where they started, hear some of their backstory, and granted there's a couple different avenues in terms of their industries, but there were a lot of synergies, and a lot of them came from real estate. They were either passively invested in real estate, or they themselves were actively had a family office that heavily was invested in real estate. So there was a common trend across multiple high net worth individuals that I worked with. So that kind of planted a seed in my head to explore this further, to potentially have my own private, chef working in my house and maybe a multi-million-dollar yacht on my dock. So
So how did that transition happen? You're partying with, millionaires, billionaires, you're having fun, and now you're getting into the grind, buying multifamilies. I'm sure you didn't start in multifamily, so maybe you can tell us a little bit about it.
yeah, so I mean, it wasn't obviously an overnight thing. It was something that I've always thought about ever since. Again, being exposed to this type of clientele. There is some real estate background within my family. My grandfather actually had his own successful business in Central and South America in the shoe business, but he did funnel a lot of that cash flow into real estate. So he bought real estate over time. Obviously, that kind of trickled down to my mom. She also, as she had her own successful business herself, she also kind of followed the same path and invested into real estate too. Now she's retired, living a great life. She still works here and there on her nonprofit, but if you look back to like what truly gave her the financial freedom, it was ultimately the her hard work that funneled into the real estate. So there was always all of these multiple angles, I guess, of nuggets that were coming through and giving me kind of these little, you know, I guess, paths of where success would look like. So that kind of funneled me into exploring that more, just real estate as a whole. So I started my kind of real estate career, let's call it, in just traditional buy sell residential. So I got my license through Keller Williams. I was rookie of the year. Did really well with just the traditional buy sell transaction side of things. And looking down the barrel for, let's call it, my second year, I mean, we were on track to making $300,000 in GCI. So that seems good on paper, but I think what you do with those funds is probably the most important next step, right? And given all of these, thoughts going through my head of how to kind of paint this path for my future, instead of kind of stepping up into the rat race, let's call it, and buying the nicer car or buying the nicer house, I would funnel a lot of those funds into real estate deals of my own. Started with, short-term rentals, long-term rentals, and fix and flips, and then, saw kind of where that path was leading me to, and that eventually kind of got me into the multifamily space. So I'll kind of stop there and see if you guys have any questions on that at all.
I think this really resonates so much with what we hear from physicians. You can definitely work harder. Being an agent is not easy. You're constantly grinding. You might be rookie of the year one year, and next year you're not getting any deals. And so at some point you hit a ceiling, and whether that's more financial or physical or emotional exhaustion, just like the doctors, you talked about a little bit about where to put that money. So how did that transition go from being an agent to actually putting some of that money into a fiscal asset?
Yeah, it's a great question. I mean, if you look at the truth behind the curtains, it's a very transactional industry, right? Being a real estate broker, right? So you can make, like, to your point, you can have a really great year and make a ton of money. And then obviously the tax man comes at the end of the year, since we're, paid out differently. And if you don't set yourself up for success there, that's a problem. But, being such a high transactional, industry, it's almost like, how do you plan for the bad year, or how do you plan for where you're going to park this money? Because I mean, we saw it in the boom of 20 to 2022. I mean, I saw people in my office with not one, but two cars. They had the nice car now versus the previous car they were driving the year prior. And it's just comical to look at that. And I've actually been able to kind of like have some, let's call it, coaching classes in the Keller Williams office of, like, how do you actually have this path to to wealth, right? And I think a real estate broker can do very well even if they're in their first year. But again, it's how do you kind of maintain that wealth and make sure that you can grow it by making smart decisions and not getting stuck into the rat race. So to kind of answer your question a little bit more, it's I was looking at that as an option, and I again wasn't really as savvy as obviously as I am today. So I looked at mentorship programs. I looked at individuals like yourself, Daniel and Lila, about having their own firms or funds to be able to park the money to at least leverage their experience, right? Because I was still running a full time job as a broker, and I have a couple different businesses on the side. So for me, it was saying, hey, if I'm going to be doing this, I'm going to go all in. What is that next step, right? So started into kind of like the fix and flip model. So did some single family flips in the Denver area. Those were pretty successful. Had some people kind of reach out looking to, jump into the next deal with me since I was advertising, some of our success stories. That kind of triggered into like the next, I guess, step up in the career was, hey, there's clearly a path here of growth, not just within the money that I'm putting in, but potentially with other people's capital. So started kind of a smaller friends and family round with some smaller fix and flips that went pretty well, and saw again the path of this transactional industry, which was again the fix and flip model where you can do extremely well, but once you stop flipping, you turn off the hose, right? So although in theory it made sense, it kind of got me back into the same cycle. So then I started to look at even a broader horizon, was like, okay, what is really this next tier of, let's call it financial freedom in a sense. But obviously it's going to be not today. And that started to trigger into more of the multifamily investing, right? So started to kind of look at the model of what we had in the fix and flip world with, raising capital, and said, okay, well, I can maybe do this on a smaller multifamily. So started in the smaller multifamily world. I was looking at 10 to 20 units at the time, did some acquisitions there that did very well. And over some blood, sweat, and tears, obviously those were good lessons learned. I realized that I can do a 10-unit multifamily, buy a 100-unit, almost the same amount of work in terms of underwriting and due diligence. You just need more capital, right? Maybe some people on your team. So that's eventually how we started to get into some of the larger multifamily assets.
That's a really interesting transition. And I think for physicians especially, that actually is a really important kind of mindset shift, because you went from this kind of model where it's essentially eat what you kill, and it was very transactional. It was very sort of like deal based, in terms of getting a profit, to the multifamily world where you invest your money, and then even if you're, obviously it takes some maintenance to grow it, but you're not having to work every single day to allow that sort of deal to progress and grow. It's almost like it is growing for you in a way once you kind of set up the parameters. So making that transition, can you walk us through, when was there a light bulb moment when it was clear that you had to sort of get away from the transactional to that multifamily?
I mean, again, just looking at the transactional moment was great. Boom, we got this big pop of capital after a successful, let's call it a successful project or deal, whatever we were working on. And now what, right? Now we have to hunt for the next one. Or if we had one all, in parallel also moving, it was kind of this like rinse and repeat model, which in theory makes sense, right? I mean, again, you can make, a tremendous amount of money doing that, but you're now looking at the barrel of short-term capital gains, depending on if it's a quicker flip versus a longer flip, right? So then I'm starting to look at also tax strategies in addition to what I'm currently kind of, to your point, like, what is that light bulb moment? Well, what can we do to continue maybe A, making this less transactional and more wealth building? And then B, how do I do this with like the most significant amount of tax savings compared to like a short-term capital gain? So then that's when the kind of the light bulbs started trickling in our world. We're so, we should be so grateful that we have podcasts like yours and podcasts like other people's in the real estate world. And I mean, now with AI, I mean, the amount of knowledge you can get within seconds is absolutely fascinating. So with that, I really just kind of took some podcasts and books and, went down a rabbit hole and realized that, with bonus depreciation and some of this long-term generational, wealth with multifamily was kind of like that next thing. So I wouldn't say it was like a specific light bulb moment per se, Daniel. I just think it was a combination of things of like really, I guess it was like this level up that I kept seeing, and I kept hitting the top of this level, which again, I could have grown to a pretty successful fix and flip business in a sense where we could be doing 5 to 10 transactions a month, which a lot of people do. But for me, it was again like, how do I make this into more of a longer term wealth where, hey, one day if I want to go take a week off and have the team run the ship for a bit, I'm able to do that. And I feel like with the fix and flip model, at least in my experience, it'd be harder to do that than in multifamily.
But how did you get over that sort of fear factor where, you're making a really significant shift from fix and flip to multifamily investments and, even taking investor capital, these are friends and family and you're taking their hard-earned money and, putting it into investments. How did you get the confidence to do that? And what were those early days like when you were kind of starting that process?
Yeah, it's a great question. I mean, I'd say two main points. Number one, work with a group that has success, right? I mean, look, like chatting with you too, I know a lot of your investors or physicians and people that don't have the time or are really experienced to do, to invest in, or I guess to be actively investing in real estate, they might be better off passively investing. So working with a group like yours would be number one. And then B, if you are going to be doing it on your own, have a great mentor. There's a lot of programs out there that you can, pay for or be part of. So I would say for me, it was definitely scary, but I think if you stay scared, you're never going to grow, right? I mean, I like to push the limits a little bit more. And I'm a big believer of you have to build the plane while you're already flying, right? That's one of my favorite quotes. If you're always waiting for that perfect time, you're going to be sitting on the sidelines forever. So for me, it was something that I kind of took my own capital and learned a lot along the way. Fortunate to say that we didn't really lose anything at the time. We learned a lot, but that next tier, or I guess that next level up, I mean, we just had to take the plunge, right? So for me, it was make sure that you have good people around you, right? Good mentors. Had a good team to kind of support me on that next, let's call it level up. And I'm an all-in guy. I mean, if I'm going to be doing something, I'm going to be doing something all in. So I mean, I at the time I really took a step away from my residential real estate business, which was producing a ton of money for me. But for me, it was take a haircut. I mean, take a huge haircut now on my active income, but maybe look at what it's going to look like in 5 or 10 years. That was my goal, and seeing what the path of multifamily could do for me, I was ready to take that risk. And for those who want to invest with me, I think they saw that I was committed to get it done right.
And Teddy, you said a lot of very interesting things, especially taking on capital and managing other people's money. When you first took that first dollar from your family or friends or anybody, right? Your super wealthy friends, what did that feel like? And what did that teach you? Did you have how did you even have that first conversation with these million billionaires?
Yeah. I mean, it's always a little nerve wracking taking anyone's capital. I mean, I mean, even to today, I mean, every decision that we make within the firm, Javi and I, my business partner, who I know you guys spoke with, like, we're always going to look at each other and say, what is the best decision here for the investor? Right. I mean, there might be something that's better for the business plan, and there could be something that's better for the investor. Right. So we're very, very investor first there. But to kind of answer your question, I mean, it's always nerve wracking because some people, I mean, even if you have a smaller deal, we're doing a $50,000 minimum, or even a $25,000 minimum. I mean, for some that might be nothing, but for some that might be everything they have to invest, right? So it's definitely nerve wracking there. But I personally invest in every single deal that we buy, and the firm, that's something that we've always done since day one. So I would never take someone's money if I'm obviously not going to invest in it myself. So I think for me, that's number one. Is it's not it's obviously nerve wracking, but I'm not too concerned because again, it's there's always a saying that like if your grandmother would invest in this deal, would you go for it, right? So that's the mindset that I have, is if I'm not going to invest in this deal, why would I ask for money? So for me, it was always my path was always to have a successful transaction because I'm going to be alongside our investors with capital.
That transition that you had where you started kind of pulling back from the sure thing of the transactional real estate broker deals to, really betting on yourself and building this company and, higher ground investment group. It really resonates. A few years ago when I was kind of putting together serious real estate, I had to give up a full-time doctor job, and, went part-time and locum tenens. And that I think was a tremendous I mean, I was so tortured about it. So I can imagine, how you must have felt when you were making that transition. That's huge. But I think carving out that time for yourself to really commit it to a company, I think that's unfortunately necessary. And that is where I think a lot of times the medical community fails doctors and other medical professionals, where they don't give you that freedom. I mean, you can't just go to your hospital employer and say, I'm thinking about starting this company. I'd like to just cut my hours back about 50 or 60%. You're cool with that? Pretty much it's going to be, what the answer is going to be. So, the freedom that you had in making that decision, that's amazing.
Yeah, and I tip my hat to you too, Daniel. I mean, it's a scary thing, right? And I mean, I don't have kids, so it's a little bit different for me. I can risk it all if I want to, but you have a family and kids, so it's even a bigger concern. So, but with those people surrounding you, if they can agree and they're happy, and obviously they're alongside you, which your family was. I mean, that's a big success story in my eyes. But it's always definitely it's always concerning to take, I guess, what you're looking down the barrel of this consistent payout every single month, and now you're going to take this big plunge. And it's the way I see it is, if it failed, which I don't really ever want anything to fail, there's always something you can go back to. But I'd rather be in regret that I don't want to be in a regret that I didn't try, I guess. So for me, I'm an all in kind of guy.
Yeah, I think the blessing that I had was the support of my spouse, honestly. Both financial, because she works full time. She's amazing. She's a museum director. And also kind of conceptually, she was on board with the, risk taking that I was kind of proposing. So that was pretty amazing. Before we move on, do you mind just bringing up to speed, like, where is Higher Ground Investment Group today? It's like, how many units do you guys manage, and what's on the horizon for the company right now?
Yeah, we're plus or minus about 700 units total. Might be a little bit off of what Hobby said because there's a couple properties that we bought before Hobby kind of joined, but about 700 units total. Majority of those, about 550 of those, are in Des Moines, Iowa. We're closing another 135 units in hopefully the next 30-ish days. Just got some delays there, but that's kind of where the firm is now, and we're going to continue to be buying in these Midwest markets or sister-like markets, because for us, it's been our best producing market, and we do love the yield, and we love kind of more of those steady Eddie boring markets. So for us, that's going to be our main focus here for the next 5 years.
All right. So, Teddy, I'm going to just shift gears a little bit because I think this is where our listeners really need to hear from you. So, recently on social media, I got, I'm basically on the algo for these multifamily deals. And everywhere I look, it's 20 IRR, 30 IRR, 40 IRR. And everything looks incredible. But we know that real estate syndication have been through a huge storm recently and is starting to stabilize. So maybe you can give us the real deal, the unfiltered picture of what it actually looks like to get into a real estate syndication right now.
Yeah, I mean, it's interesting you say that. I mean, I think there is like a bad stigma, at least over the last couple of years, with syndications, right? I mean, I think a lot of people rode this really insane wave from, let's call it the 2020 years, and they all banked on these 6 to 10% rent appreciation, rent growth year over year for the next 5 years. And it's fascinating not only how people A invested in those deals, but B also how banks loaned on those deals. I mean, it's you can look back at all the historical data points, and there was never really something that can really sustain that growth year over year. And that's a compounding mistake. If you miss 3 points year one, you got to catch up on year two, and it's a compounding mistake, right? So to kind of answer your question, I think what we're seeing now, again, there is a bad stigma to what syndication is, but I think the operators that bought well, operators that bought with fixed debt, those guys are doing okay. I don't think anyone knew what the interest rates were going to be doing, even the ones that have been doing this for 30 years. So that's really, it's a shame for a lot of those individuals, and even the ones that bought very expensive rate caps, they still exceeded those. But what we're seeing now is, the Sun Belt markets are taking a hit. Some operators, if they get at a good buy, they're still able to take these discounted assets and do pretty well. I think those Sunbelt markets are seeing a decent peel back on rent growth, which if you're good at what you do in that market, you're probably doing a negative, negative rent growth year over year, depending on the submarket, right? This is thinking macro level. But I'd say good operators that are still around and doing well. I mean, they're still transacting. I think there's a lot of people that are in trouble right now, and we're seeing a lot of lender relief that's starting to, I guess they're starting to run out of that relief in a sense, and they're kicking the can down the road for too long. But we have been seeing a lot of creativity with lenders to try to make sure they don't take back the asset. At the end of the day, they are in the business to loan money, not manage a property. I think they are now coming to, seeing, I guess, the truth behind the scenes of what operator actually has a chance versus doesn't. And they're giving those with a chance some more time, and they're looking at the ones that just really just didn't do a good job, or nor they will. They're just foreclosing on those assets, which gives us more of an opportunity on the buy side. But for any individual, again, within your investors that are looking to invest in syndications, I wouldn't just shy away from them completely. I still think there's a lot of really good opportunities over there. It's just taking the time, with your due diligence, speaking with, like Lila and Daniel, taking the time to speak with you guys and make sure you guys know what you're talking about, know the numbers like the back of your hand. You're very confident in the business plan, not only about the deal itself, but who's managing the asset, right? That's very, very important. And have their own due diligence. And, before I would put money in my LP deals, I'd call brokers around that market and say, "Hey, I'm investing in this deal. Would love if I could take 2 minutes of your time. Do you think this asset is going to be generating, this much per rent for a 2 bedroom? And do you think a 2% increase year over year is good?" If you call a good broker, they'll be able to tell you off the fly. A good market knowledge broker should be able to tell you that. So taking the extra layer, I guess, and not just trusting the team, but also trusting the numbers, and taking an extra layer, an extra step to make sure that everything within the deck looks right, and make some calls. I mean, you can do it in, I mean, a phase one, in my opinion, due diligence. If you're an LP, you can do it in one day. Just call around and ask the right questions.
That's great advice. And, I hesitate to say this because podcasts live forever, but I do think we're going to look back on this sort of window of opportunity right now as one of the best windows over the next, decade or so in terms of putting capital into multifamily and into housing, just because of where we are in the market. Do you agree?
Yeah, I agree. Again, it depends on a macro versus micro, lens, right? But there's a lot of units that came online, I guess, from the COVID delays, right? And that's why we saw a lot of rent pullback from, let's call it 23 to 25 ish, depending on the market. And then we also saw a lot of people that did not, there were not a lot of permits issued because they were still trying to fill the units, right? So we're going to see this little bit of a lag. So I'd agree with you, at least in the markets that we're in, right? I think there's also another layer of complexity, not just about deliverables of newer multifamily, but also some markets with tenant laws that are changing, right? I mean, we're heavily invested in a red state, which is in Des Moines, Iowa. Our tenant laws there are actually in our favor. We're also invested in Colorado, and I know Lila's there, where you might be seeing there's a lot of blue tape that's been changing to the point where it's making it really unsustainable for landlords to kind of do what they need to do, which is just manage these properties. So I think, again, at a bird's eye view, I would agree with you, Daniel. But getting to the the nooks and crannies, it's going to be very dependent on which market you're investing in.
Yeah, that is so true because I do invest in Dallas as well, which we love. And it's definitely a very landlord friendly state. And I think we are able to get somebody out within 27 days. I think with the new Colorado regulations that came into place, it's 60 to 90 days because there's a lot of procedural things that you have to go through before you can actually kick somebody out.
And that's accurate, as everything's exactly the day it should have been done. We have tenants that have been delinquent for about 190 to 200 days, and we have a writ of removal, but the sheriff is so behind that they can't even evict them in person yet. So, I mean, it's taking some properties, 8 to 10 months to get them removed.
And how do you respond when someone says, that's great because we don't want landlords to have the power to kick people out, willy nilly. That is awesome for the everyday man. How do you respond to that from like a real estate investor standpoint?
Yeah, I mean, that's where you kind of like back up the lines of like, just trying to be a good person, right? I mean, there's no there's no day where I wanna kick anyone out to the curb. There is never a day where I feel okay doing that. That being said, if you show up to a restaurant and you ask for a nice steak and mashed potatoes, you start to eat it and then you don't wanna pay them, do you think that's fair? It's the same concept for us as landlords, right? I mean, at the end of the day, you are paying for a service, you're paying for a roof over your head, and I sympathize if you have some financial distress. However, at the end of the day, we have a no pay, no stay kind of like, you know, formality in some of our markets, and we're willing to work with them on some stipulations, right? If we take them to court, we'll say, "Hey, we'll give you, you have to pay X amount in 2 weeks and then the full amount in 4 weeks." We're happy to kinda work with them, but once you kinda know a tenant or 2 and you're doing the runaround every single month, and at some point, it's just maybe just not a good fit. So, it's difficult to kinda answer that because, again, like, I do have a heart, I do care about people that are going through some financial distress, but at the end of the day, I mean, there are many creative ways to make money in this world, and a lot of the people just take advantage of the system versus really being in financial distress.
All right. Yeah, fair enough. So let's bring it home for our listeners. So a lot of our listeners, as you know, are physicians. They're tuning in and just trying to figure out how to make that transition, like you did, basically from this model where it's essentially eat what you kill. You're an hourly worker, essentially, for most physicians now. 70+% of physicians are employed, and you need to start putting your capital to work. So, what is that sort of elementary piece of advice you would give to physicians who are thinking of starting to invest capital into real estate? What's that first step that they should take?
Yeah, I mean, definitely reach out to operators like yourself, kind of get a pulse in the market, see where they're investing, see where maybe other operators are investing. At the end of the day, I think it's really important for people to, wherever they invest their money, they also want to believe in the story and the deal itself, right? So if you don't really know the market very well and you're not confident in the market at all, why invest in there just because you like the operators, right? I think it's really important for you to trust and like the operators, but also really enjoy the market itself and do your own due diligence. But for those that are just getting started off, I mean, there's no surprise that real estate is one of the top, investment vehicles that are out there, right? I mean, if you want to be more of a steady Eddie S&P 500 guy and index funds, by all means, that's great, but that's going to be slower wealth building, in my opinion, right? And you could diversify. You could look at some of those index funds for maybe a percentage of your portfolio, and then maybe a little bit more, let's call it higher risk in some people's lens, but make way better returns on the real estate side of it, and obviously including the tax benefits it has to offer. But I'd say for those that are looking to kind of get started, start chatting with a couple operators, see who kind of fits your mold and who you kind of feel better to work with. Because at the end of the day, although you're a silent investor, you're technically married with them for about 5 to 7 years, depending on the length of the deal. And do your due diligence, right? Look at the numbers. If you have an accountant or you have a financial advisor, leverage them, have them review the deck, have them review the underwriting, have them reach out to the operators. I mean, I have a lot of calls with some financial advisors when people are looking to park money in our deals, and that's totally fine. So I just think, just taking the time to do the right due diligence, invest in multiple deals. Don't just put all of your money in one deal. I think that's a really important thing too. And not just diversifying in multiple deals, but maybe diversifying in multiple more markets as well. And make sure, again, that the people that you're parking your money with are looking at you as an investor, but also kind of assisting you with this wealth building. And they are doing what is needed in terms of the tax structure or the entity structure to make sure that you are going to be maximizing your tax benefits, and you're doing it ethically, of course, because a lot of people do kind of push the boundaries to juice their losses. But at the end of the day, the last thing anyone wants to do is get audited and then fail the audit. So just make sure everything is done correctly and by the book. And I think that if you choose the right operators and you choose the right deal over the long run, you will always win in real estate.
Really great advice, Teddy. I would also add to that is finding the right team is so important. It's finding the right CPA, tax specialist, finding the right financial advisors that's willing to work with you versus just wanting to put, your capital into stocks and bonds and mutual funds. Because that's definitely what I have seen going through the journey of my husband is some financial advisors are not as broad in their knowledge of investment products. They don't understand real estate. And so as soon as somebody presents them a deal in real estate, they'll tell them, don't invest, it's high risk, don't do it. When in fact, me and my husband have used real estate to not only grow our wealth, but also to preserve our wealth, especially in terms of taxes. We're able to successfully reduce our taxes for the last 5 years through the benefits of real estate and all the real estate regulations versus, stocks and bonds. You don't really get that. You can do tax harvesting, but you need an actual loss to do tax harvesting versus in real estate, you don't need a loss on revenue to give you the depreciation back. So I think that's very, very interesting.
Yeah, it's good that you brought that up. I mean, not just having an accountant, but having the right one that's going to be savvy in the field. It's shocking to me how many accountants that we've sent K-1s to, and they're telling us that these losses are not done ethically. You know what I mean? And it's even more shocking that I've had to educate another CPA. You're looking at a college dropout over here that's had to educate another CPA on tax strategy with real estate, right? And typically when that happens, we don't obviously want to offend, but our firm, we do have an accountant, shout out to True Books, that they do, we pay them like an annual fee to have them kind of like a tax consultant for us. So if there's ever any discrepancies between their accountant and ours, we just kind of connect the dots, and it's part of our kind of service, and they kind of educate them on how to do it correctly to make sure that everyone feels comfortable within the process.
Yeah, and I've started to use Jerry as well after having a conversation with you, Teddy. So yeah, I'm in year 2 with them, because my previous CPA actually told me not to do cost seg, which I didn't listen to him. I'm very stubborn and rebellious in that sense, and I come from a financial world as well. I still have my CFP, so certified financial planning degree. So I just needed to find somebody new, and I knew that you were working with them already. So thank you so much for the introduction.
Of course, of course. They're probably sleeping now. It's April 17th when we're recording this, so they just had an incredible week. So yeah, I'm glad you connected with them, Lila.
I think bottom line, you don't have to do it alone. I think the thought of dipping your toe into real estate is so intimidating to so many people because it's not taught in school. No one knows about it until you actually go after the knowledge. But there's so many people out there who are willing to, help you get into it. So amazing. So Teddy, thank you so much for joining us today. I think this has been a really great conversation that really encompassed the breadth of the decision-making process to kind of get into real estate and also some really good actionable advice. So how should people get in touch with you to learn more about your company if they would like to do so?
Yeah, I mean, they can reach out through Instagram. I think it's teddymo.re, or just the highergroundig.com is the website. Again, always happy to be a resource. Like Lila started off. I mean, there's so many people that have helped me along my journey, and I'm always happy to repay the favor. So feel free to reach out anytime.
Well, perfect. Well, thanks so much.
Awesome. Thank you all for having me. I appreciate it.
Thanks for tuning into Paging Financial Freedom, where we help doctors and spouses like you take control of your finances, invest smarter, and build a life by design.
If you enjoyed today's episode, don't forget to subscribe, leave us a 5-star review, and share this with someone who needs to hear it.
And remember, financial freedom isn't just a dream, it's a decision, so let's get there together.